Hello and good morning. Welcome to Tandem HR's 2015 third quarter webinar. My name is Lisa Gagliardo and I am one of the senior HR consultants here at Tandem HR. With me this morning is Greg Foss, Compliance Manager, as well as Amanda Harper, Manager of Benefit Administration and Reconciliation, also with Tandem HR. Tandem's goal is to simplify the people process, enabling organizational leaders to maximize return on investment in people and concentrate their efforts on driving organizational success. As HR experts, we aim our quarterly webinars to provide a value add for our client owners and their employees. To omit any static or interruptions, I have placed everyone on mute. If you have individual personal questions, please feel free to contact me or your HR consultant offline. We will be addressing the questions at the end of today's session. So let's get started. Now that we know the Supreme Court has affirmed the Affordable Care Act, or the ACA, is constitutional, we know it's here to stay. Companies such as yours need to ensure compliance in the ACA to avoid potential steep penalties. The goal of our presentation is to help you understand what is required of you or your company to avoid those penalties and provide you guidance on what needs to be done. I must mention a few things before we really start to dig in. The information in this presentation is based on Tandem's interpretation of the IRS guidance provided earlier this year. ACA seems to change on a day-by-day basis, so some items may be subject to further regulatory clarifications. This presentation is to provide guidance on how companies are required to engage in ACA compliance. It is not intended to provide legal, tax, accounting, or benefit advice. Finally, this presentation may not be appropriate for all employers. Multi-employer plans, government agencies, educational institutions may have different requirements which may not be covered under this presentation. Let's take a step back and look at how the ACA evolved in the last 5 years. The Affordable Care Act has certainly been a phased-in approach with reforms including adult children would be permitted to be covered as dependents up to the age of 26. The medical loss ratio was established. Beginning January 2013, W-2s distributed to employees of large employers are required to report employer aggregate costs of coverage for employee paid benefits. New rules regarding the summary of benefits and coverage, SBC's uniform glossary, became required. Starting in January 2014, individual mandates required all U.S. citizens and legal residents to have minimal essential coverage or face tax penalties. Another mandate was waiting periods for coverage cannot exceed 90 days from the employee's date of hire. So as you can see, there is many that have already been implemented, but the list can go on. Just wanted to show you a small snapshot of what have already been passed. During the next hour, we will help you navigate through the 2015 mandates, including the employer shared responsibility. And our goal is to help you answer the questions, does your company need to comply with the new ACA coverage and reporting requirements? And if so, who needs to be covered and what type of reporting is required? Does your company qualify for an extension? And why the ACA mandates matter to my organization? There's a wealth of information and opinions from multiple sources available to us every day. We use many of these sources to aid in the information presented today. Our goal is to put you at ease with better understanding of the recent ACA requirements to ensure your company maintains compliance and serves as a resource to you when you're ready to dig deeper or need additional assistance. So let's start with the basics to determine if your company needs to comply. If your company is ALE or applicable large employer, for sure you need to pay attention. An applicable large employer, or ALE, is defined by the IRS as For each year, employers that had 50 or more full-time, including full-time equivalent FTEs in the prior calendar year. So in simpler terms, if you employed 50 or more full-time employees or full-time equivalent the last calendar year, your company is considered an ALE. But you also have to consider your control groups, which we will address in a second. So to determine if you are an ALE, first, each employee who works more than 120 hours a month is considered a full-time employee for ALE determination purposes for that month. Then for FTEs or full-time equivalency, you will need to add the remaining hours worked for all employees who worked less than 120 hours a month and divide by 120 to determine your full-time equivalency for that month. Then average your monthly totals for the number of full-time and full-time equivalents for the prior calendar year to determine if you are ALE in the subsequent calendar year. So now the question posed, does your company have a sister company or another company that has common ownership? Companies that have common ownership or are otherwise related are called a controlled group and generally are combined and treated as a single employer. These companies would be combined for purposes of determining whether or not they collectively employ at least 50 full-time employees or full-time equivalents. If the combined total meets the threshold, then each separate company is subject to the employer's shared responsibility provisions, even those companies that individually do not employ enough employees to meet the threshold. The determination of whether or not you are a controlled group with another entity should be discussed with your outside legal counsel or tax accountants, as the rules are complex. For ACA purposes, the controlled group rules follow the same rules as the IRS controlled group rules related for a retirement plan. So let's start with employer shared responsibility to understand the type of coverage that is required to be offered. The provision states an employer must offer minimum essential health coverage to full-time employees and their dependents that is both affordable and provides minimum value. This provision did not come into effect until January 1st, 2015, which means no employer shared responsibility penalties will be assessed for 2014. Employers will use information about the number of employees they employ and their hours of service during 2014 to determine whether they employed enough employees to be an applicable large employer for 2015. So now Amanda will dig a bit deeper to dissect the requirements of the employer's shared responsibilities.
Thank you, Lisa. Identifying full-time employees is important for two purposes under the rules for the employer shared responsibility. The first is to determine whether an employer is considered an applicable large employer and therefore subject to the employer shared responsibility rules. If the employer is considered an applicable large employer, as Lisa defined previously, the employer is now required to determine which employee must be offered coverage in order to avoid the penalties under the employer shared responsibility. When we assess how many full-time equivalent or part-time employees an organization has, any employee on your payroll for an average of 30 hours per calendar week or more, or 130 hours per calendar month during those defined periods, the employee then should be considered a full-time employee as it relates to the medical insurance coverage. Keep in mind, for the purposes of ACA, a full-time employee is considered benefit eligible for medical only. There are no requirements for part-time, non-variable hourly employees to be offered coverage at this time. Regulations provide two measurement periods for determining whether an employee has enough hours of service to be considered a full-time employee: the monthly measurement method and the look-back measurement method. Different methods can be used for certain specific categories. Some examples of those include salaried versus hourly employees, employees in different states, and union versus non-union employees. It will be up to you to determine what measurement method you would like to use. The key point here is to stay consistent. Also, keep in mind these methods can be used for determining an employee's full-time eligibility, but should not be used as a technique for determining if your employer is considered an applicable large employer. Let's start by looking into the monthly measurement method. The employer determines whether an employee works sufficient hours of service in a particular month to be categorized as a full-time employee. Once the employee drops below 30 hours per week or 130 hours per month, the employee is no longer eligible for benefits. On the flip side, if the employee did work full-time hours in a month and the employer did not offer sufficient coverage, the employer would then be subject to penalties for that month. As you can see, this measurement technique is not ideal for employers who employ variable houred employees, as hours can jump up and down from month to month. Let's work out an example here. Your company has an employee who is a variable houred employee that can be scheduled between 25 to 35 hours per calendar week. This employee has maintained a 30-hour per week schedule for the month of May, but in June has dropped down to 28 hours per week, then back up to 32 hours per week in July. For ACA purposes, this employee is considered benefit eligible for the month of May, then no longer benefit eligible for the month in June, but then again benefit eligible for the month of July. Let's jump back into the second measurement method. This is called the Lookback measurement method. The Lookback measurement method allows an employer to calculate full-time status for variable houred employees. This method can also serve as a confirmation to ensure all other employees are or are not benefit eligible. During the measurement period, there are no employer mandates liability as long as that employee is offered compliant coverage as of the first day of the corresponding stability period once an average full-time schedule is established during the measurement period. With this method, the employer may determine full-time status of an employee during a future period. This future period is referred to as the stability period. The hours of service the employee worked in a prior period is referred to as the measurement period. The measurement period is defined as the length of time an employer must evaluate the hours worked by variable houred employees to determine whether they are eligible for health care coverage in the upcoming coverage year. Currently, measurement periods should be between 3 to 12 months and need to coincide with that stability period. The stability period is the time during the coverage year that a variable houred employee must be guaranteed access to coverage, even if the employee is no longer working those full-time hours. Of course, this being said that the employee still remains with that employer. The stability period needs to meet or exceed the time frame of the measurement period. The final consideration is the administrative period. The administrative period is available to accommodate employers that might need some time between the standard measurement period and the stability period in order to determine which employees are eligible for coverage and, of course, any other administrative purposes. This period provides an open enrollment for any newly benefit eligible employees found through this measurement method. To prevent an administrative period from creating a potential gap in coverage, it must overlap with the prior stability period so that ongoing full-time employees will continue to be offered coverage during the administrative period. To sum this up, you have the administrative period to do administrative aspects needed to determine who is benefit eligible, the measurement period to confirm employee eligibility, and the stability period to offer coverage.
Thanks, Amanda. Now to understand if an employer plan is considered affordable, the employee's share of the premium for employer-provided coverage will cost the employee not more than 9.5% of the employee's annual household income. But because employers typically will not know their employee's household income, employers can take advantage of one or more of the 3 affordable safe harbor available. Please note, your broker should be providing you guidance if your plan is affordable. And to understand if your plan provides a minimum value, it must cover at least 60% for the total cost of benefits that is expected to be incurred under the plan. The Department of Health and Human Services and the IRS have produced a minimum value calculator. By entering certain information about the plan, such as deductibles and copays, into this calculator, employers can get a determination as to whether the plan provides minimum value. Again, your broker should be providing you guidance if your plan provides minimum value. Greg will now help you understand if there are any extensions or traditional relief available to you.
Employers with 50 to 99 employees have an opportunity to qualify for transition relief, which can delay employer mandate requirements until January 1st, 2016. Employers must meet the following requirements to qualify for this relief. 1, the employer cannot reduce employees or the hours worked to get below the 100 full-time or full-time equivalent threshold unless for a bona fide business reason unrelated to the employer mandate. 2, the employer must not eliminate or materially reduce its coverage as measured on February 9th, 2014. 3, the employer must engage in significant tax reporting under Section 6056 of the IRS Code and certify it is eligible for the 50 to 99 full-time and full-time equivalent relief. We will talk about this reporting in a future slide. It is important to note that the employer can still qualify for this coverage and pay the penalty for not offering health insurance. In other words, employers can delay paying the employer mandate penalty for 1 year if they qualify for the 50 to 99 relief. However, transition relief is not guaranteed and should be discussed with your outside tax and legal advisors to determine if you qualify for this specific 50 to 99 transition relief. Employers can also take advantage of non-calendar year transition relief if they qualify under separate criteria. For example, if you have an October 1st renewal date, you may be able to delay some ACA requirements until October 1st, 2015. But your company, 1, must have offered a non-calendar year plan as of December 27th, 2012 and not modified your plan renewal date since that date. 2, you must play when the time comes in order to apply for this relief. In other words, you must offer coverage as of their first renewal date in 2015 if you qualify for this relief. 3, the employer must engage in the same tax reporting under Section 6056 that we will discuss in a later slide. And finally, you must have offered coverage to a certain percentage of current employees during the last open enrollment period. These criteria can be very complex and should be reviewed with your outside tax or legal counsel before taking advantage of this relief. But the same with the 50 to 99 transition relief, non-calendar year transition relief is not guaranteed.
By now, you should have an understanding if your company needs to comply with the employer's shared responsibility provisions. If you are an ALE, it would be a good idea to understand the penalties should you decide not to comply. The primary employer requirements and penalties for noncompliance under the Patient Protection and Affordability Care Act, or PACA, are contained in the employer shared responsibility provision of the Act. The requirements in this provision pertain to 2 areas: employer mandate or play to pay, and providing coverage that is affordable and of minimum value. Under the PACA or ACA, local, federal, insurers, employers, individuals are given the responsibility to reform and improve the availability, quality, and affordability of health insurance covered in the United States. Employers are not required to offer health insurance, but will be assessed penalties for not doing so. This is known as play or pay. In February 2014, the IRS and Treasury Department announced the PACA Employer Shared Responsibility Mandate to take effect in January 2014, but subsequently was delayed until 2015. So what does this mean for your company? Employer mandates are in the process of being phased in so that employers with the 50 to 99 full-time employees or full-time equivalent would not be subject to play or pay penalties until January 2016, as long as the employer satisfies certain transition relief criteria. Under the 2016 mandate, an employer that does not offer coverage to at least 95% of their full-time employees and their dependents could be subject to the play or pay provisions. The mandate will continue to take effect for employers with more than 100 employees or full-time equivalent. In 2015, these employers will need to offer health coverage to 70% of the full-time employees. 2016 and beyond, a 95% standard will apply. If these mandates aren't satisfied, employers will be assessed a penalty of $2,000 per full-time employee minus the first 80 employees in 2015 or minus the first 30 employees in 2016, and if one full-time employee receives federal premium subsidy for marketplace coverage. So all it takes is one person to receive that subsidy. For example, if an employer with 150 employees does not offer health insurance to its full-time employees and dependents, and at least one employee purchases a subsidized health plan, the penalty in 2015 would be $140,000, which is 150 minus the first 80 employees times $2,000. In 2016, the penalty would be $240,000, which is that same 150 employees minus the first 30 employees times $2,000. If we move down the chart to focus on value and affordability, an employer will be subject to a penalty if the sponsored coverage is unaffordable or does not provide minimum value, and if one or more full-time employees obtain a subsidy from a federal or state health exchange. Generally, employees who are eligible for employer-sponsored coverage are not eligible to receive subsidized coverage through an exchange. However, an employee may qualify for a subsidized plan if their household income is less than 400% of the federal poverty level, and if the employer's plan is unaffordable or does not provide minimum value. As a reminder, for an employer plan to be considered affordable, the employee's share of the premium for employer-provided coverage would cost the employee not more than 9.5% of the employee's annual household income. And to be considered a minimum value plan, it must cover at least 60% for the total allowed cost of benefits that is expected to be incurred under the plan. Monthly penalties for noncompliance of the affordability and minimum value include penalty A and B. Penalty A, or 4980HA, will not be greater than the monthly penalty that would apply if the employer offered no coverage at all. So this would equal to $2,000 divided by 12 months in a year, multiplied by the number of full-time employees employed during the applicable month, not counting the first 80 employees in 2015 or first 30 in 2016. Penalty B, or 4980HB, is assessed for each full-time employee receiving subsidized coverage through an exchange for the month. This would equal to 3,000 divided by 12 months in the year. Now these are the employer's penalties. Now for the individual mandate penalties. The Affordable Care Act requires nearly all Americans to purchase health insurance that meets its standard of essential health benefits or pay a penalty. Premium credits and cost-sharing subsidies will be available to low-income individuals for the cost of health benefits. Individuals who choose not to buy health insurance will be subject to a tax penalty. Individuals with no coverage in 2015 will pay the higher of these two amounts, either 2% of the gross household income or $325 per person for the year. In 2016, the penalties will increase to $696 per person for the year, or 2.5% of the gross household income. Penalty for dependents under the age of 18 is 1/2 of the individual amount. Now your company is complying with the employer's shared responsibility. How do we prove it to the IRS? The following reports are required to be filed for both the individual as well as the employer mandate. With Section 6055, or the individual shared responsibility provisions, employees can use this form to show compliance with the individual mandate of the ACA. And with Section 6056, or the employer's shared responsibility provisions, employers can use this form to show compliance with the employer mandate of the ACA. To dig a bit further into each section, the ACA requires any insurance provider who provides minimum essential coverage to an individual during a calendar year to report certain health insurance coverage information to the IRS using Section 6055. Section 6055 includes a transmittal form 1094B, which is filed along with the employee statement form 1095B. The 1094B requires information about the entity submitting the form, while the 1095B is provided to each responsible individual and requires information about the provider of the minimum essential coverage, information about the responsible individual, as well as identifying information about each covered individual. This reporting requirement is effective January 1st, 2015, and the forms are to be provided to the employee by January 31st, 2016. The health coverage provider must file the information return and transmittal form on or before January 28th or March 31st if filed electronically. If the year following the calendar year in which provided minimum essential coverage to an individual. Entities with a controlled group must complete Section 6055 on an entity-by-entity basis. Also, if minimum essential coverage is being provided to a part-time employee, minimum essential coverage reporting will apply as well. So whether the employee is full-time or part-time doesn't really matter. Reporting is required for any individual who is being provided coverage. The ACA also requires employers to report annually to the IRS whether they offer full-time employees and their dependents the opportunity to enroll in minimum essential coverage under an eligible employer-sponsored plan. The 1094C is a transmittal of employer-provided health insurance offerings and coverage information. Employers are required to file with the IRS a transmittal document for Forms 1095C, which is the employer-provided health insurance offerings and coverage, and provide a summary of aggregated employer-level data, which includes identifying information about the employer, whether the employer is part of a controlled group of entities, whether the employer qualifies for transitional relief, months the employer offered minimal essential coverage, as well as the number of full-time employees in each calendar month. The 1095-C is a statement that summarizes the employer-provided health insurance offerings and coverage. This statement is provided to each responsible individual and requires information about employer's offer of coverage, amount of the employee's share of the lowest cost monthly premium for employee-only minimum essential coverage, and whether the employee was enrolled in coverage, or if not, an indicator code requiring why the employee was not enrolled in coverage. This reporting requirement is also effective January 1st, 2015 for employers with 50 or more applicable full-time employees or full-time equivalents. Applicable large employers must file the information return and transmittal form on or before January 28th, March 31st if filed electronically, of the year following the calendar year in which it provided minimum essential coverage to an individual. Entities within a controlled group must complete Section 6056 on an entity-by-entity basis. Also, employers must report for any employees who is full-time for at least 1 month in the year. So you probably have information overload at this point. So let's just summarize what your company needs to do from this point. First, you need to determine if you are an ALE. So discuss with your payroll or your time and attendance provider to obtain monthly hours. Verify your employees are reporting all hours worked. Speak with your tax accountant and outside legal counsel to determine if you are a part of a controlled group. Determine if you have employees reported on a separate payroll system. And if you are an ALE, your broker can help you determine if your health plan is affordable and offers minimum value. Finally, if you are an ALE, you need to determine who is going to handle your IR payroll provider, your broker, or third-party administrator. So a few takeaways based on this presentation. So first off, work with your vendor to determine who is helping with what. If you are a client of Tandem HR, you should have or should be responding to the letter on what is expected of you. IRS reporting is required with employers with 50 or more full-time or full-time equivalent employees. So at this point, we would recommend that you take action right now. So Greg and Amanda have been monitoring the questions asked during today's webinar. They will select a few and provide answers for the benefit of all present during this morning. Amanda, do you have some questions?
Yes, I see a question about seasonal employees. The question is, my company employs seasonal employees periodically throughout the year. Will these employees be counted when determining the employer shared responsibilities? The answer is this: seasonal employees are taken into account when determining full-time employees. Seasonal employees are defined by the Department of Labor as employees that work on a seasonal basis. You can use examples like retail workers who work throughout the holiday. If your workforce exceeds 50 full-time employees or full-time equivalent during this seasonal time period for no more than 120 days, your company is not considered an applicable large employer, therefore would not be bound to the employer shared responsibility requirements in this case. Greg, did you have more?
I have a few. First, we have, can you please confirm that the companies with 49 or less full-time and full-time equivalent employees are not required to do anything at this time? And that is correct. Companies with 1 to 49 full-time and full-time equivalent employees are not subject to the employer mandate for 2015 or 2016. Unfortunately, we are not aware if this is going to change beyond 2016. However, we want to stress that you do need to make sure that you consider if your entity is related to a controlled group as the multiple entities within the controlled group will need to be added together to determine if you are over that 50 full-time and full-time equivalent employee mark. The next question that came across is, are there any mandates in 2016 and beyond that we need to be preparing for? As you are aware, the ACA is changing day by day. The biggest item in the news that you're probably hearing about is the Cadillac Tax that's going to take effect in 2018. At this point, the recommendations that we're seeing is to discuss the Cadillac Tax with your brokers to make sure that if your plan potentially is going to be taxed with the 40% excise tax, that you do make modifications now to try to avoid that tax in the future. One of the other questions that we're seeing come across is trying to determine the requirements or the eligibility of a full-time employee. You may have noticed that there are two different definitions of full-time employees. So to determine if you're an applicable large employer, there is a 120-hour-a-month requirement to determine how many full-time and full-time equivalent employees that you have. After you've determined that you're an applicable large employer and need to comply, then you need to then each employee who works an average of 130 hours a month should be determined benefits eligible. So once again, it's 120 hours to determine if you're an ALE, and once you determine that you're an ALE, it's 130 hours for those employees that should be offered benefits coverage. The next question that I'm seeing come in is related to the forms that we mentioned. Form 1095B is a form that will be sent to, Form 1095B will be sent to all of your employees. That form is going to be coordinated by your insurance provider. And yes, it will be sent to the employee's home address, and just like a Form W-2. The next form that the employees are going to be receiving is the Form 1095C. And yes, that form is going to be sent to the employees' home addresses as well. The Form 1095C is going to be provided by the employer. So this is a form that you need to work with your payroll advisor, or your payroll provider, your tax accountants, your broker, to determine who is going to be sending out that form. As if you are a Tandem client, you would have received a letter from Tandem within the past month discussing how Tandem can help the employers with this reporting requirement.
Okay, so then another question that's coming in is, which Tandem staff person do we contact regarding the affordable and minimum value requirements? This would be your broker. So if you are a broker with Tandem's BSG, you would be speaking directly with your consultant on those type of questions. We do have multiple other questions, but I do also understand that this is a lot of information for you to really absorb. And you're probably going to have more questions once we do conclude this presentation. So if you have any kind of questions after today, please feel free to reach out to your consultants, to your benefits team. Tigran will be more than happy to answer any type of questions. Also, any additional questions asked today, we will go ahead and we will answer them within the next 48 hours. And we hope that you had you enjoyed the presentation and you found it informational, and tried to make it as simple as possible to gain a better understanding of your requirements under the Affordable Care Act. So again, thank you for your time that you have spent with us, and I hope that each of you have a wonderful day. Thank you.